This video covers Chapter 29 and 30, and it will cover money, banking, and the Fed, and Chapter 30, which is monetary policy. Okay, so the first part of this video will cover the money multiplier, which is the basic concept you need to understand how the Fed tools work in monetary policy. And then we'll cover traditional tools. We'll cover the discount window, reserve requirements, and open market operations, and how the Fed uses these tools to conduct monetary policy, which is the last part of this video. And by monetary policy, we mean how does the Fed conduct its policy so that it can manage the economy in a way that it wants to try to achieve full employment and a targeted or minimum level of inflation, which is about 2% right now, a targeted 2% inflation rate. Okay, so let's get started. First thing we want to do is we want to define the money supply. There's a number of ways to define the money supply. The easiest way, and the one we're going to use for this chapter, is that it's currency in circulation plus checkable deposits. Checking accounts, in other words, demand deposits. So the money supply is money, things that you can convert and quickly into other assets. And so if you have currency in circulation, that would be money in your pocket, that would be money in cash registers. Okay, so that's certainly money supply. That's easy to see. A little slightly harder to see is the checking deposits and what are called demand deposits. They're called demand deposits because the bank has to give you those deposits on demand. They can't delay the return of your money. They're not going to charge you a fee. They're not allowed to charge you a fee on that. So they're demand deposits. So those deposits can be converted into cash very quickly. It's considered part of the money supply. Okay. There are so this is basically the version of called M1 version of the money supply. Basically, there's checking or travelers checks involved. They're really small. Most people ignore them. And we will ignore them for the most part here. So that would be what's called the narrowest definition of the money supply: circulation, money in circulation, and checkable deposits. There's also a version called M2, which is called the broader measure of the money supply, and that equals M1 plus, I guess conceptually the best way to think of it is it represents savings, and in addition to M1, it represents savings and time deposits. Time deposits being certificates of deposit, which usually have a stated maturity associated with them. So you may go to the bank, your local bank, and you open up a 1-year CD. That means you're promising to tie your money up for 1 year in that CD, and if you decide to withdraw your money early, you're going to get a penalty for it. And so that is, it's not quite as flexible as a checking deposit because you're committed to keeping that money in for a certain period of time. It could be 6 months, a 6-month CD, a 1-year CD, it could be a 2-year CD. Okay, so it's not quite as flexible because of that penalty and the fact that you've basically promised to lock that money up. So those are the two measures. For purposes of this chapter, we're going to look at this guy. We're going to look at the money supply as being currency in circulation and checking deposits. And what we want to do now is we want to look at the money multiplier. How does that money multiplier work? It's the key to understanding how the Fed operates in this chapter and the next chapter, and not just in these chapters, but how it operates in the real world. So let's jump right into it. And the way we're going to look at it is, let's assume now we got this individual. And this is classic. I mean, all the textbooks start out this way. You're going to assume that somebody has, in our case, let's say it's $500. They have it buried in their backyard. It's under their mattress. It's somewhere hidden in an attic, and it's been out of, it's been there for a long time. And now suddenly, somebody finds that money and wants to deposit it in a bank. And so they're going to deposit that in the bank, and what's going to happen is it's going to set off a chain reaction, a multiplier, where the money supply is going to grow much beyond the 500 initial change. So let's look at how that works mechanically. So here we have Bank A. So that $500, what's going to happen is that $500 is going to get put into a checking deposit of 500, and that is a liability to the bank. That's why it's on the right-hand side of this T account. Okay, and so you know books have to balance, and so I'm doing a balance sheet here. I'm saying assets, and then there's liabilities, and we're going to ignore equity here. But normally the accounting identity is assets equal liabilities plus equity. We don't really need to focus in on equity here, so we're just going to say assets equal liabilities. And so if you deposit $500, and let's say it's you deposit $500, it's going to put money, cash, in the bank's assets. It's going to be an asset to the bank, right? So it's going to be an asset on the books because they're going to have access to that cash. They're going to have a liability of $500, obviously, because they're going to, if you want your money back, you're going to come in and they're going to have to give it back to you. They're going to have to drain the cash out of their asset, out of their vault, out of their cash registers, to give it to you to pay off that deposit. So reserves go up 500. Okay, so your balance sheet balances, and that's important to know. A balance sheet, that's why it's called a balance sheet. It balances, and so your assets equal your liabilities. Okay, and that should make sense. Now, what you need to realize is that banks do not have to hold all of this money in the bank. We are a fractional reserve system, our banking system, and it's that way across all the developed countries in terms of the banking system. So in this course, we will assume that reserve requirements, we'll call it RR, are 10%. And what that means is the bank will have to keep required reserves at 10% of this. In case, you know, there's a lot of people come in and all of a sudden want to pool their money, because you're not the only depositor here. In case a whole bunch of other people wanted to pull their money out, the bank has to have some cash on hand to be prepared for that. And that's why these reserve requirements are there. And so that's a buffer for that individual bank. And if this bank would run out of required reserves, in other words, there was a bank run or just happen chance that a number of people decide to withdraw some big money out of the bank has access to the Federal Reserve, which they can borrow money from the Federal Reserve to get additional reserves to back up their checking accounts. Or they can borrow it in what's called the Fed funds market. The federal funds market is a market of loans that can be bought and sold basically between banks. And so if you're a bank that's short reserves, you go into the Fed funds market and you borrow money overnight for a very short period of time, and that will cover your required reserves. And these reserves are required by the Federal Reserve. And if you have excess reserves that are above and beyond what's required, then you can lend them out, because a bank has a profit motive. We can't lose sight of that fact. Banks have profit motives, so that when they have excess reserves, there's an opportunity cost to holding that money, and they want to lend it out. And if they don't have anybody to lend it out to in traditional loans, like to a manufacturing company or some type of business, they'll lend it out in the Fed funds market to another bank that happens to be short reserves. Okay, now back to this example here. Reserves just went up, and so I'm calling this R reserves, $500. It really can be decomposed into two components, actually. And the one is required reserves, which are 10%. Okay, so it's $500 or $50 for required reserves. And then excess reserves are $450 at this point. So I can cross this out and say, look, this $500 represents $500 in cash in the vault of the bank. 50 of it is required to be on hand, and then 450 at this point is excess reserves that can be lent out. It's excess. This bank, if it keeps those excess reserves in cash, it's going to lose opportunity costs. It's going to money, profits, because it could lend that out. And so we're going to assume that the next step is this bank is going to lend this 450 out. And so when it lends that 450 out, the excess reserves disappear and it becomes a loan of $450. So notice, at every single point in time that I did this, the balance sheet balanced. And that's the point. No matter what you shift around here, the balance sheet at any given point in time has to balance. So you have a loan of 450, required reserves of 50, and it all works out. Now, what happens to this loan? Well, somebody borrowed it, and somebody borrowed it to expand their business. So they're going to take that and they're going to expand out their business, and that's economic growth. That's good. So lending is good. People just don't borrow money for nothing. Typically, we're assuming that it's going to be put to good use economically. So now, the person who borrows this, who gets this loan, is going to, and we assume for simplicity, that it's going to be deposited in another bank. And the reason why we say it's assuming it's deposited in another bank is it keeps the bookkeeping a little easier here. There's no reason why that this 450 couldn't be redeposited in Bank A. But let's put it in Bank B. So Bank B's checking deposits are going to go up by $450 because let's say it's a construction company borrows the $450. They're going to put that money in Bank B. And so Bank B is going to have required reserves of 10%, $45 they're going to have to keep on hand. And then they're going to have excess reserves of $405. And so notice we balance 450, 450. Okay? So now what's going to happen is excess reserves, that's a no-no for a bank that's looking to maintain profitability. And so they're going to get rid of these excess reserves by lending that money out. And it's going to turn it into a loan of $405. And so again, we balance out, and somebody is going to borrow that money, and let's say they deposit it in Bank C. And so 405 gets deposited in Bank C. And then their reserves are going to go up by required reserves. Oops, I should put an R here by the way, RR, required reserves, and an RR here for required reserves of $40.50. And then the excess reserves are $364.50. And again, we balance out at 405. And this continues. It continues to the point where the mathematics are that the change in the money supply here, because notice what's happening is checking deposits are going up. So the change in checking deposits, this is a change in the money supply, equals the initial change in reserves. Right? So it's the initial change. We started way off here. The initial change in reserves, and the initial change in reserves, by the way, is 500. It's this whole group here, not just excess reserves. The change in reserves, there's no X there, times 1 over RR, the reserve requirement. I guess there should be capital R's to be consistent with what I did earlier. Okay. So that is how the multiplier process works. And so you can see that when somebody deposits money in the bank, there's a chain reaction. The money actually multiplies out, and so your total change in deposits ultimately comes out to be the $500 initial change in reserves. And if you want, maybe you could call this initial, so you keep it clear. The initial change in reserves times 1 over 10. And so the change in the money supply would be $5,000 due to that. Okay? Now, so the money supply increases. Now, we also assume, by the way, that in this whole process, nobody kept cash in their pocket. So this person who borrowed the 450 deposited 450 here, and this person who borrowed the 450 deposited the 405, went to 405. Nobody kept any money in their pocket. They deposited everything 100%. So there was no what we call cash drain in this example. And so the multiplier process, here it is. If there was cash drain and people were holding a percentage in their of these transfers in their pocket, then the money multiplier would be much smaller, has the potential to be much smaller than 10. 10 is the multiplier. Oops, I should put this, be careful here, 0.10, so the whole multiplier is 10, okay? 0.10 reserve requirement. Okay, so now what happened? And well, when this happens, when you take money that's been sitting out for a while in the middle of nowhere and deposit it in the banking system, you've just increased the money supply. And we should take a look at that because it's an important component here. So here we have the quantity of money, and here we have the interest rate. So this is the price of money and the quantity of money, price and quantity, just like we've been studying the whole semester. And so here we have what we call money demand, and that's the demand for money to be held for transaction purposes. So you hold money in checking, in demand deposits, and in your pocket to conduct business. And so if interest rates go really high, so you're changing interest rates. When you change this axis, you're sliding along. And so if interest rates are high, people are going to want to hold less money because they're going to want to put it in the bond market where they can earn a good high rate of return because the opportunity cost of money is high. When the opportunity cost of money is low, money demand will be low. Actually, I'm sorry, money demand will be high because you're moving out in this direction with low interest rates. There's no opportunity cost to holding money in your pocket. That's where we are today. Today's environment, interest rates are so low that nobody really thinks about it anymore. The fact that there's some opportunity cost. There isn't much of an opportunity cost at this point. Rewind to the late 1970s and 80s when interest rates were 15% in some cases. People were worried about how much money they held in their pocket because they knew that they were losing out. They were losing out from a couple different dimensions. One, inflation was eating away at their money at a very quick rate, and then they weren't earning any interest on the income that they had, or the cash that was sitting in their pocket. So we have a money demand curve that slopes downward, and we assume that the money supply curve is a vertical curve here, or a vertical line. Okay, the Fed sets the money supply independent of interest rates, and that's how to interpret it. And there's an equilibrium interest rate here where money supply equals money demand. Now, when you deposit, or anybody deposits money in the bank, it's going to push out this money supply curve. So it moves out, and the money supply curve prime here, and interest rates decline. And that interest rates decline, that means that you're going to have higher investment, okay, because it's cheaper for companies to borrow money. And you can see this is consistent with money supply going down because when you add money to the banking system, you know, banks now have more funds available to start lending, and so they're anxious to lend. All else being equal, they're going to have to lower interest rates to get more and more people to borrow. So the money supply moves out, interest rates come down, investment goes up, and also autonomous consumption goes up because that's the consumption that people buy, you know, through credit cards, or even home equity loans are a function of that, where people borrow money to consume. And the typical examples are money to buy a car or a washer machine or a dryer, or some type of durable good that lasts 3 to 5 years. People borrow money. They tend not to borrow money for toothpaste and things that are that have very short lifespans. They borrow money for things that last reasonably long periods of time. Okay, so that's the background. So now you can see why changing with a fractional reserve system, making a deposit can have an influence on the overall money supply. Now what we want to do is we are now going to talk about the tools of monetary policy. And the tools of monetary policy are, the first one we'll cover is the discount window. Now, banks are required to hold money as reserves to back up their deposits, but sometimes banks run into trouble. They get in a pinch, and they could be, for whatever reason, they're unable to borrow money in the Fed funds market from other banks. Other banks are suspicious of their financial stability, and so the Fed is there to as a lender of the last resort, and it lends through what's called the discount window, and it has a discount rate. The discount rate today is 0.75. It's usually a function of the Fed funds rate. So the Fed funds rate is set between, the target rate is between 0 and 0.25, which is really about in the middle range is 0.125%, very low rate. And so what typically happens is, under normal conditions, the Fed often will tack on 1% on top of that to make it, to make it 1.125% for the discount rate. But in today's environment, they've set the discount rate at 0.75, so that to entice banks, if they need to come to the window. To borrow money if need be. They don't want to try to restrict that, given the financial situation we've been in the last couple of years in the banking system. So this discount rate is 0.75. Now, they can move that up or down, this rate, to encourage or discourage lending. And so if a bank could go, let me use a new T account. Let's say the bank wanted to borrow money through the discount window, Bank A, and it could borrow the money, and then it would have the reserves on its books, right? It would have the reserves here for, let's say it borrows $1,000, and so now it has reserves that could be assumed to be excess reserves that can be lent out and just continue that multiplier process. Now, how does that work? How does the math behind that? Well, the Fed, so here you have the Fed. I'm running out of space here. So here the Fed will, on its books, will increase reserves by 1,000 as a liability base, or as a liability. So basically what this is saying is, look, we're holding reserves of $1,000, and it's on this bank's books as reserves. In order to get these reserves, this bank would have had to use, say, some type of security that it owned. So it could have owned a treasury bill or a treasury bond, and that treasury security went to the Fed. So now the Fed has that treasury, we call it T security for $1,000. Okay, so the Fed makes an electronic credit, basically, and for the $1,000, and takes possession of treasury security. So its books balance, because it increased here by 1,000, increased this by 1,000, and for the bank, their reserves increased by 1,000, but there's this negative sign in front of the treasury security that just went out the door to the Fed. So overall, there was no change on this side, and there's no change on this side of the balance sheet. Okay, I'll have more to say about this implication, because this is related to open market operations, but I'm not getting there yet. Give me a little bit of time. So the point is, there's a discount window. The Fed can encourage or discourage borrowing from banks, borrowing and lending by banks at the discount window by changing the reserve requirements. It typically does not do that very often. So, I mean, it did it in the financial crisis. It changed the discount rate, but typically that's not its ordinary tool for conducting monetary policy. The second tool is reserve requirements. Now, I assumed, and it's not a bad assumption for doing calculations here, that the reserve requirements is 10%. So every dollar that gets deposited, the bank has to keep 10 cents in the vault, so to speak. It's in the vault, or 10 cents with the Federal Reserve. And so the Fed is the one that determines that rate. And so the Fed could change that interest rate. And let's say the Fed, I mean, think about this. Let's say the Fed changes it to 12%. That means that for all, what that means is any bank, let's say I'll just make up a new balance sheet, call this bank D, okay, Bank D. So let's say it has checking deposits of 1,000, it has required reserves of 100, and it has loans of 900. So notice it balances. So there's a bank sitting there, and then it's suddenly the Fed says, we're changing the reserve requirements and we're moving it up to 12%. What that means is this bank now has to hold 12%. And that means it's going to have to liquidate 20 of its loans. It's going to have to drop its loans down to 880. So this thing stays at 1,000. So things have to balance. And so when the Fed increases the reserve requirements, forces the banks to hold more money, it basically works the opposite direction as what we just showed with this deposit of $500 from this money that came out of the backyard, so to speak. So now notice what happens to the new money multiplier. The new money multiplier, on top of the cumulative effect of the unwinding of all of those deposits through that drop in loans, the change in the money supply now due to a change in reserves times 1 over RR, now it's 12.12. Now what we end up with is with a multiplier of 8.33. The multiplier has now dropped. And that in and of itself will have an effect on the overall banking system. Okay, so that was the second traditional form of money management and money tools that the Fed has, and that's a big one. You know, big reserves, big changes can happen with reserves. And by the way, the Fed does not, our central bank does not change the reserve requirements very often in this country. They're relatively stable. Some countries use changes in reserve requirements as a primary tool for managing monetary policy. For example, I hope you can see this. What we have here is we have, change the lighting here. We have, I have a slide here that shows you the reserve requirements for China. And so the reserve requirements for China, for large institutions now, you can see it dropping. And those, look at the reserve requirements. Look at this axis here. It's in the 20 upper teens, 20% area. And so before the Great Recession, reserve requirements were coming down, easy monetary policy, as we'd say, flat monetary policy, and then restrictive monetary policy. So the multiplier is dropping off, and every one of these notches is a change. Why did they change and start having a restrictive monetary policy? Look over here. In the same time frame, you can see that loans, bank lending, the change in loans from year to year, look at the spike, 35% gain in bank lending. Banks that lend like that are going to fuel bubbles. And the bubble that was the concern is the banks were lending to the real estate market. And they lent to the real estate market, it causes real estate prices to bubble up. And so that bubble could pop easily. So China had to do some preventive work here, try to prevent a possible bubble popping. And so what it did was it increased its reserve requirements, which unwound a lot of loans in the first place, and then dropped the multiplier. The multiplier ended up falling. And so it notched it up, all the way up to, to 2011, and then it brought it back down because what's happening? Their economy is starting to cool off, and it started to cool off a few years ago. So it started to cool off. They started to bring down the reserve requirements to try to free up some more money to increase the money supply and reduce interest rates in the economy. So, so here you can see the Fed, the Bank of Japan. You know, look at all the 1, 2, 3, 4, 5, 6, 7, 8, lots of changes. Right now, as of December of 2015, this has come down to 17.5%. It's 17.5% for a reserve requirement. Still much higher than our 10% reserve requirement. But that's how the Chinese manage their monetary policy. Okay, so now let's get to the last tool, traditional tool. Okay, and that's open market operations. This is our Fed, our central bank, the Federal Reserve's primary traditional tool for managing the money supply through open market operations. And it has the Federal Open Market Committee. Federal Open Market Committee is the committee that is responsible for deciding these open market operations. And what open market operations are, let me see if I can give you a bank, a brand new bank called Bank G. So here we have Bank G, and it has checking deposits of 1,000, and it has reserves of 100. And let's assume instead of having loans for 900, we're going to say it owns a T-bill for 900. So again, things balance. Okay, so banks are allowed to own treasury bills. They're risk-free. They earn interest, and so it's consistent with their profit motives. It's liquid, which is good. And so here we have Bank G sitting there. Everything's fine. And let's say now the Fed wants to, but notice, by the way, that this doesn't do much good in terms of a money multiplier, having a treasury bill in the books. But notice what happens. What can happen? Let's say the Fed wants to increase the money supply. And what it can do is it can go and buy treasury bills, purchase treasury bills from banks. And it's going to purchase a treasury bill. So here we have the Fed up here. And the Fed is going to purchase treasury bills for 900. So it's going to credit its reserves for Bank G, reserves for Bank G. So put a little subscript G. For 900, it's going to get a treasury bill on its books for 900. So the change in the assets and liabilities of the Fed will remain equal. So it went up 900 here, went up 900, everything balances. And what happens here is the Fed buys this, so this treasury bill went over to the Fed, and the Fed is going to give reserves to, and by the way, these are required reserves, they're going to give reserves of $900 to this bank. Now this bank can use these reserves to lend, and like we did in the previous example. So the bank can turn this into a loan, $900 loan immediately. So notice it's meeting its reserve requirements already, and it's got this excess reserves at this point. These are its reserves, but they're excess reserves of 900. All of that can be converted into a loan, which would end up on the books of, Bank I, for example, for $900. It would end up as a deposit at Bank I. There would be required reserves of 90, and there would be excess reserves at this point of 810, and the whole process just continues through. So that's an example where the Fed purchases a treasury bill, and it adds liquidity to the market. Money supply ramps up, and we have an increase, a decrease in the interest rate to try to try to spur investment and consumption. Okay, the Fed can do the exact opposite, and instead of purchasing a treasury bill, it can decide to sell a treasury bill. And so if it sold a treasury bill, it would look something like this. It's a little weirder. It's the same thing in reverse, but it's just hard to think backwards. It's a little more abstract, at least from my point of view. So here we have the Fed it owns a T-bill. Say it's 900, and it has reserves of 900. So the Fed balances. Let's say we have Bank J. Okay, and Bank J let's say it has loans on its books. This would make up a number, 10,000, and it has checkable deposits, demand deposits of 10,000. Okay, so now the Fed wants to sell a treasury bill, and when it sells a treasury bill, it's going to give up a bill, and it's going to get cash. Okay, so it's going to give up this treasury bill, T-bill, just put 900, T-bill drops off. Okay, and so it's going to drop off that T-bill, and what's going to happen is reserves are going to dry up by 900, and so you're going to have a zero change in the Fed. Okay, and it's going to sell that treasury bill to, say, Bank J. So Bank J is going to get a treasury bill on its books for 900. The way it's going to do it is it's going to have to liquidate loans, and it'll liquidate loans to $9,100. Okay, so now the Bank J balances, there's still 10,000, 10,000, and so what will happen then is Bank K will, so this ends up with a reduction of loans of 900, which means checking deposits have to dry up by $900 in Bank J, which means their reserves are going to drop by 90, and their loans are going to drop by 810, and so on. So the whole thing trickles down through, so you get the multiplier in reverse. The change in the money supply shrinks from that whole process of the Fed Fed actually selling a treasury security, getting the cash. So the Fed absorbs cash out of the financial markets, okay, by giving the financial markets a treasury bill, selling on a treasury bill. That is open market operations. That is a huge deal in the U.S. It's conducted every week, nearly every week. The Federal Reserve, primarily in the Bank in New York, the Federal Reserve Bank in New York is the one that conducts most of this open market operations. And by the way, you might ask, where did this minus 900 come from, and how does that work? Well, remember, back here, the Fed owned the T-bill because at one point it bought a treasury bill, so treasury bills on its asset side of its balance sheet, and it credited reserves for some bank. Could have been Bank J, called RJ for, there's a J right there, for $900. Now when the Fed decides to reverse this process, it's going to sell the treasury bill, get rid of the treasury bill. It's going to get rid of those reserves, and those reserves are going to shrink, and that's going to have a cumulative process. Speaking of shrinking reserves and reeling them back in 2008, the Fed now pays interest on reserves. And that's an important element. That's an important change to the Fed. And so what that means is, look, we know that historically we saw reserves at the Fed move something like this over time, and then they spiked up in 2008, 2009. They spiked up as the Fed bought a bunch of securities to reduce interest rates across the board, meaning short-term and long-term. They bought a bunch of asset-backed securities and mortgage-backed securities. Reserves increased, and now people are very worried about whether or not this will transmit into money supply, and it all depends in part on whether or not banks decide to lend. If banks decide to lend and take their reserves, so here's Bank A, for example, and it's sitting on tons of reserves, right? Will Bank A convert that into loans? Well, a lot of banks have not converted that into loans, which means the money multiplier has not taken effect, because there hasn't been enough demand for that. So what people are concerned about is, look, as soon as the economy starts getting really strong, and it kind of has already, but it gets really strong, banks will start lending. And when they start lending, this multiplier process I've been explaining will increase, will blow up on us. The money supply will get out of control, and we'll have inflation. So remember the old money equation that I showed you in class one time. You could think of GDP as the price times quantity for all goods and services. The price of the goods times the quantity. So this is for all assets. You're adding this up, this multiplication here. You'd add up each one for every good in the entire country. You'd add up. So this would be like billions of goods that you'd add up. Take the price, multiply it by the quantity. That would be the GDP for the year, and that equals the money supply. I'll call it MS, money supply, times the velocity of money. How fast does money turn around in transactions? How many times does it get the same dollars, basically, same dollar bill go from one transaction to the next? And so if we think of basically quantity of goods and services remaining unchanged, just conceptually think about that, and the velocity of money remaining unchanged, then if the money supply spikes up, then you're going to see a rapid increase in prices. I mean, it's the old story that you've heard before is, let's say overnight the Fed doubled the money supply somehow, just doubled the money supply in the economy. What would happen? Well, you and I wouldn't be producing any more goods and services. The velocity of our transactions, the number of transactions that we process in a year really wouldn't change. What would change would be prices. Prices would now double if the money supply doubled overnight. So with the reserves being really high, that has the potential to igniting this multiplier effect, which has the potential of doing this, increasing inflation dramatically and suddenly. So in 2008, the Fed sought to get to pay interest on reserves, and other central banks around the world do pay interest on reserves, so this is nothing new to central banking per se. But our Fed here in the United States started paying interest on reserves, and the reason was that when they start paying interest on reserves, they now have an additional tool, a non-traditional, non-classical monetary policy rule or tool, call it Tool 4. I mean, we looked at the discount window, the reserve requirements, and open market operations. Think about item number 4 is interest on reserves. And so the Fed now has a tool that's independent of open market operations. All it has to do is increase the R, the interest rate on reserves that it pays banks. So what it's doing is the reserves that banks have that are held at the Fed are earning a rate of interest. And all it has to do is increase that interest rate, and it'll stop banks from making loans. You know, if they're getting a good return from the Fed, why should they lend the money out to customers with risk? They can get a no risk rate of return from the Fed, and the Fed can control the dial on this interest rate. Then the Fed can, in effect, stop this multiplier process from happening. So that's why you listen to Ben Bernanke and others when they testify in Congress and are on television getting interviewed. They're fairly confident that the blow up through the multiplier process won't happen because they have this tool of paying interest on reserves. Okay, now we're going to transfer into chapter 30 now on monetary policy. As a way of introduction into chapter 30, let's again look at the money supply, money demand equation graph. And so here we have the quantity of money, and here we have R like we've had before, and you've seen many times before. But now I want to talk a little bit more about this money demand equation. We have, by the way, a vertical money supply. Here we have the equilibrium interest rate. Now let's talk about how money demand shifts, how this curve shifts. We know that we run up and down this curve when we change this interest rate. We run up and down this curve. When interest rates are high, people will not hold money because of the opportunity cost is high. And so you move up in this direction. If interest rates are low, like they are in today's environment, then people just hold money and they don't even really care about the opportunity cost, because there is hardly any opportunity cost. They use cash for convenience purposes and checking accounts for convenient purposes. So we're over here. Now, we did talk earlier in a previous chapter that when the price level goes up, so let's look at the factors that what I'm getting at is what shifts MD, the money demand curve. And we saw in a previous chapter that when the price level goes up, money demand shifts up and we get a higher interest rate, which kind of makes sense, because what's happening is if price level goes up in general, we're going to have to hold more cash to transact business. And so you'd have a ramp up in the money demand. And the opposite would happen if the price level fell. We would have a drop in money demand, so you'd have a come down and interest rates would fall. That's not too hard to see. The next one, the next shifter would be changes in money supply, or not, changes in real GDP. Okay. So a change in real GDP, let me give you a fresh graph here. So here we're looking at, if we have an increase in GDP, it means there's more transactions happening, we have more activity in the economy, then that's going to cause the money demand to go up and interest rates to go up, all else being equal. We're going to have a higher interest rate with a higher activity in the economy. So when real GDP goes up, money demand will go up, and it'll also, if real GDP falls, money demand will go down and interest rates will start to fall. So there's like a correcting mechanism there, if you can see that. So when the economy starts to get strong, interest rates go up. See, that's kind of pushing us back into potential. So if you think of, look here, you think of a strong economy moving up in this direction here, right? We would have money demand going up, interest rates go up, would tend to cool the economy off and push it back towards long-run potential. So it's another one of the examples of, prices moving to counteract the economy. So we saw that, and we saw that with regular prices, prices of goods and services, when we looked at aggregate supply and aggregate demand. Now we're looking at the price of money and how that causes a counteractive effect. Along with the price of labor, wages, and so on, have these counteracting effects. So even if you do nothing in the economy, and the government doesn't intervene, there's these self-correcting mechanisms that are there. Now, keep in mind that there's when we talk about changes in real GDP, a corollary to that is what will also shift the money demand curve is changes in disposable income. Okay, so if your disposable income changes, you're going to shift that money demand curve back and forth. Also, tastes and preferences will shift it. And also, before I even get away from this disposable income thing, it's not only disposable income this year, but expectations for production and disposable income next year will shift that money demand curve. So if your expectations, you think production or income is going to go up in the future, then you're probably going to hold more money. It's going to shift the money demand curve up. The textbook talks about changes in technology and changes in institutions also as shifting money demand. I'm not concerned so much about that. It's not very well developed in the text. It's not important for the story that's going to unfold here in the rest of the chapter. So now let's talk about the Fed funds rate. And the Fed funds rate, as you know, is, you can think about the Fed funds rate as supply and demand for loanable money. But it's loanable money between banks. And so here you have, and I should call this, just call this Fed funds rate here. And so here you have supply and demand for federal funds, and that is a market that takes place between banks. So, you and I couldn't be involved in this market because most of the transactions are $10 million at a time. And in fact, I think futures contracts that trade Fed funds contracts, I think, have a minimum size of $10 million at a time. So there's lots of money moving here. And so you have a supply and demand for Fed funds, but the point is, right now there's a current interest rate for Fed funds, right? So you have a current supply and demand, but there's also, you could think of this supply and demand graph here as applying to the future. So if this month is December, there's also, and that's the supply and demand curve for December, there are people out there and banks anticipating and scheduling what their supply and demand for reserves will be and their money flow. And so they're looking at a supply and demand graph or at least thinking, they're not going to graph it, but they're going to think in terms of supply and demand for Fed funds in January, in February, and so on, way out into the future. So banks are not just going to ignore the future, they're going to try to anticipate the future. And in some cases, what they'll want to do is if they see a shortage, let's say they see a shortage in the amount of cash that they're going to have on hand, because they know they're going to have to lend a lot of money out, or maybe they're going to have to pay off a big deposit or a series of deposits, and they know that what their cash flow is going to be. They may want to lock in their borrowing costs, so they'll predict what their borrowing, how the capacity of their borrowing or lending, and what they'll do is they'll go into the Fed funds futures market and try to, and in there, lock in an interest rate. So you can, right now, if you're in December, you can lock in an interest rate for borrowing in the Fed funds market for January or February or March and so on. And so that way banks can have a handle on their costs, and also on the revenue side, because they can lend in the Fed funds market. So the point is, there's a Fed funds market for today, which is basically called the spot market, on the spot. And there's a Fed funds market, supply and demand, for January, February, all the way out into the future, as various banks try to determine what their liquidity will look like. And so you can go to this CME, Chicago Mercantile Exchange, and you can look up Fed funds rates in there and what the market expects Fed funds to be. So if you're sitting here in December and you look at the Fed funds futures contracts and the interest rates that's associated with them, you can get an expectation. You can develop an expectation of where interest rates will be in the future. And so that's what the Fed funds market is sometimes, and the futures market in general, is sometimes called a price discovery mechanism, because through the futures markets you can see what the market is anticipating future prices to be. Okay, now so that's a little bit about Fed funds market. Let's talk about the Fed funds rate over time. So here I have a graph. Take a look at the Fed funds market over time. So here's 2004, if you can't see it here, through 2009. We saw, this is the Fed funds. Now, what we need to clarify here, this is the Fed funds effective rate. That means basically the actual rate. And it's basically over top of the targeted Fed funds rate. So the Fed sets a target for interest rates. For the Fed funds rate, it sets that target and uses open market operations primarily to hit that target, to make sure that the interest rate is set. So what I'm saying is, the Fed has a certain target, and so if this is where we are today in terms of money, let me give you a better example here. So we have money demand and we have money supply. And let's call this Fed funds, and this is quantity of money. Let's say we're right here. Right now, we have an interest rate of 1%. And the Fed says, look, we want to target, we want to raise interest rates. Well, they want to raise interest rates and they have, a target of 2%. They're going to have to shift that money supply curve back into the left to hit their target. And so they're shifting up interest rates. Interest rates will go up. That'll reduce investment spending. It'll reduce consumption and so on. So let's look at the history. Go back to the history here of what the Fed has done. Here's the actual Fed funds rate, which is the actual supply and demand at any given point here. And here's the target that the Fed has set. And so you can see that the actual Fed funds rate and the target are, basically overlap each other. And so back in 2004, the Fed saw the economy overheating. They saw real estate prices going up significantly, and they wanted to dampen the effects. And so they started ratcheting up the targeted Fed funds rate. So they ratchet up the Fed funds rate, and as they do it, the money supply curve is shifting to the left, right? And so it went up, 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 peaked, stopped at 5%. And then when the asset bubble started to pop and subprime mortgages started to go under and we had financial difficulties, look, they started dropping the rate. Sometimes they dropped it significantly. You see there's some sharp drops there as they dropped the rate all the way down to 0, and it continues to 0 or darn near 0, between 0 and 1/4% technically today. Now, so there is the Fed funds conducting open market operations and monetary policy right there. That's examples of how it's trying to control the economy. So in a sense, the Fed was criticized heavily for if you back up, interest rates had come down a bit before 2004. They'd come down. The Fed, in hindsight, was criticized for causing but the asset bubble, the real estate market bubble, and so on. And so the Fed tightens, and then it popped the bubble, and the market collapsed too quickly. And so the Fed's criticized for having low interest rates in the first place. Then it's criticized for raising interest rates, and then it's criticized for not bringing rates down fast enough, even though they came, looking here, they came down pretty quickly. So there's people bashing the Fed. It doesn't matter what the Fed does. There's somebody's going to try to take a swing at it. So just keep that in mind when you hear criticisms as what's going on in the Fed. It's coming from every angle. Now here is a Treasury yield curve. And the reason why I have the Treasury yield curve, and you can't see this, so I'll just put a graph of it here. Treasury yield curve looks something like this in today's market. Here is the yield on Treasury securities. So these are Treasury securities. Starting at 0 maturity, and so this is maturity on this axis. 3 month, 6 month, 1 year, 2 year, and it goes all the way up, and I should put a little notch like this, but nobody does, 30 years. And by the way, there's 10 years in there too. So it's not a nice and symmetric linear relationship here with the time dimension. These are in months, which is scaled about an inch here on my paper, and then we got 20 years in an inch. So get used to that. Any yield curve you see will do the same thing. They'll focus. In other words, it's magnifying the short end of the yield curve. And so the Fed, with Fed funds market that we're looking at, this market, is the market for overnight lending and very short term, maybe a week. And in some cases it goes up to 30 days in terms of lending, but it's very short term. It's right here. And so the question becomes, how can the Fed influence long-term interest rates to try to move the economy, right? Because we made the argument that, look, you change interest rates that in turn changes investment, okay, and it changes consumption through A, the autonomous consumption. But we also made the argument that it's long-term interest rates that influence the economy. In other words, interest rates for securities that are in loans that go for 10, 20, 30 years, like bonds, for example, and that's what these are, Treasury bonds and bills. Treasury bills are 1 year or less, so it's this end which is being magnified. So how can the Fed, by manipulating the Fed funds rate, which is basically an overnight rate, which is just basically this tip of the entire yield curve, how can it change these interest rates over here? Well, that's a good question, and that's where the concept of long rates, and so here we have a long rate, for example, of 30 years. The long interest rate for a long-term security is a function of a series of short-term rates. So there's a bunch of short-term rates here. So let's say this is a 30-year maturity. Then a 30-year bond, which earns 3% per year, okay, 3% per year, means that it's also earning a rate each and every year. There's an interest rate here. And so the long rate of 30 years is made up of a chain of these short rates. And if you influence this rate, it's going to have an impact on long-term interest rates, okay, because this one's going to go up. Now, mathematically, it's almost nothing happens because this is such a small component of all the short future rates here. But there is the idea that when the Fed changes interest rates, it just doesn't tend to change them once and that's it. It changes. It tends to have a change in interest rates that sets off a pattern. So there's a trajectory here, and there's a trajectory here, and there's one here. So when the Fed starts changing interest rates, now, for example, it's teetering on considering strongly to change interest rates. People know they're not just going to change interest rates once and it's all done and over with. It's probably going to have a series of rising interest rates. And if the Fed is about to cut interest rates at some point in time, it's not going to just cut them once, it's going to have a series of cuts. So the market anticipates that. So what I need to show you, what you need to see is that even though the Fed controls this short-term interest rate, it has and just this little impact, it influences indirectly all these other expected future interest rates. And the only way I can show you this is giving you a numerical example. So here, let me give you a numerical example of a yield curve. So let's say we have 1 year interest rates to be 3%, 2-year interest rates to be 4%, and 3-year interest rates to be 5%. So we have an upward sloping yield curve. And it's sloping upwards, which means, look, long-term interest rates are higher than short-term interest rates. And there's a number of reasons for that, and it'll come out in my discussion here. But now, we know that this is a long rate, so we're looking here. These are called spot rates, by the way, spot rates, because you can spot them. I like to say, look, you can spot them with your eye right now because they're advertised interest rates. So they're spot rates, they're nominal rates, they're observable. And not only that, but they're for the interest rate on the spot, meaning on the spot means right here and now. So if we draw a timeline, and here I got a timeline here. This is today, time 0. Okay? We have an interest rate for a spot interest rate for 1-year securities. Okay, so remember, 1-year bonds means somebody's borrowing, somebody's lending, and so here this is 3%. So if you want to invest your money for 1 year in a treasury, you'd get 3% in this example. Okay. If you want to invest your money over a 2-year period, it's 4% per year. And if you wanted to invest in a 3-year period, and I'm running out of space here, I'll do it here. 3-year period, you would get 5% per year. And so what we're going to do is we're going to ask ourselves, I wonder what interest rates are going to be in the future. 1 year, starting 1 year from now, covering a 1 year period, what are interest rates going to be? What is the interest rate 2 years from now that covers 1 year? So these are called forward rates. Forward rates. You can't see them on the spot. Interest rates on the spot all start here. These are all spot rates. That's what the yield curve is made up of. This yield curve is made up of a bunch of spot rates. And so the question is, what are expected future interest rates? And we can back them out, and we can determine those. So all we have to do is a little bit of math. Basically, I'll show you geometrically what it is, and then I can show you how to do a shortcut. But basically, look at what I have here. You can earn 4% for 2 years, 4% per year for 2 years, or invest your money at 3% for 1 year and then roll it over into another bond that lasts 1 year at some mystery interest rate. We don't know what it is. Let's call it F1. Call it that F1. So we're indifferent between investing at 4% compounded twice. So take 1.01 plus the interest rate and square it, because we're investing our money twice, versus investing it for 1 year at 3% times 1 plus that forward rate for 1 year. Now notice my superscripts add up on the right, they add up to the left. So some people get uncomfortable with just looking at this. So you can think of this as, look, $1 times 4% times 4%, right, equals $1. So you invest $1, it gets 4%, and then it earns 4% again. And then that's equal to, or you're indifferent between investing your money for 2 years at 4% each versus investing your money at 3% for 1 year and then investing it at F1, which we don't know yet. Well, this is one equation, one unknown. We know what that's going to be. We can calculate it. So it's 1.04 squared divided by 1.03 equals 1 plus F1. And then F1 will equal 0.0501. And you can eyeball this. So I did this geometrically because money compounds geometrically, and so you need to, technically you need to do this, but you can eyeball it and say, look, 3% and 5% average out to be 4%. So in other words, in order for you to earn 4% for each of 2 years, you can earn 3% and then 5%, and it'll average out to 4%. That's arithmetically, and that's eyeballing it. And my numbers are very, very close here to the 5%. Now you can do the same math here and figure out what the next interest rate will be. And the next interest rate will be, look, you're indifferent between investing $1. I'll put it off to the side here. So you invest $1. And by the way, I show you $1, but multiplying by 1 doesn't do anything, which is why I basically did the shortcut here. So I'll continue with the long way, so to speak, and I'll say, look, you invest $1, and it's going to earn 5% for 3 years. Okay, that's the 5% here. And you're indifferent, that's what the equal sign is saying. You're indifferent between this return, so this is your money compounding at 5% for 3 years, and that comes out, that's easily calculated, 1.05 to the third power. That means if you invest $1 at 5% for 3 years, you'll end up with almost $1.16 right here, almost $1.16. And you're indifferent between doing that and investing your money at 4% for 2 years and then rolling it over into a mystery interest rate. We'll call this F2. So we invest for 3 years here, we invest for 2 years here, and now we want to figure out what is this interest rate that we're going to roll it over in 2 years from now that covers 1 year. That's here. And so when we do this math, F2 equals, let's see, F2 equals 0.0703. And so you can kind of see that if you take an average of 3, 5, and 7, it'll be 4, ballpark here. And so that's how we're coming up with this estimate geometrically, and using, it's sometimes called a no arbitrage argument, but don't worry about that term, no arbitrage argument. So the whole point of this is that this interest rate of 5%, which is a long rate, equals a 3% rate, a 5% rate with 5.01 basically, and a 7.03% rate. So what I'm saying is long-term interest rates are made up of a chain of the next spot rate and expected future interest rates. These are interest rates that we expect, the market expects to happen in the future. Doesn't necessarily mean they'll happen in the future, but it's what the market expects. So the point is, the Fed only has control over the shortest end of the maturity spectrum. It has control over this, right? So if it increases this 3% and say it increases it to 4 or 5, then it's going to have an impact on long-term interest rates, even if these guys stay the same. Okay, so I'll say it again. The Fed funds is very short-term interest rate in the market. It's akin to this interest rate, this 3% rate here. Okay, but the point is, if the Fed changes this short-term interest rate, it's going to have an impact on the long-term interest rate. But it's kind of small because it's only one of these three rates. And then imagine if you have a 30-year security. There's 30 of these out here. There's 30 securities, 30 expected future short rates. And so just changing this one and leaving the 29 others unchanged, that's going to have a minuscule impact on that. Okay? Mathematically, that is true. But what you have to take into consideration is the fact that when the Fed goes and starts to make a change, most market participants expect not just one change one time, but a whole series of changes. Okay? A whole series of changes means that, look, not only is the interest rate here going to change, but this interest rate in the future is going to change, and this interest rate in the future is going to change. So it's not just this interest rate that's going to go up. People start to anticipate, they rationally anticipate interest rates going up further. It's that whole series. It's not just the math, but it's the expectations and the market's expectations for the Fed to continue raising interest rates that causes the yield curve overall to shift and long-term rates to go up. Okay, speaking of future interest rates, Fed funds future rates using futures contracts, how does the market, we saw Fed funds, we saw the Fed funds futures contract quotes from the Chicago Mercantile Exchange, which gives you an idea where future expectations are for future Fed funds rates. Then I showed you, how you can back into these unobservable short rates, expected future short rates here. Okay. Now, what I'm going to show you is how you can back out and figure out and determine expected inflation. And remember that the real rate, the nominal rate, sometimes I call it NR, it depends on the textbook and the course, but R is, I'm calling it the nominal rate, equals a real rate plus an inflation premiums. Usually, I guess we'll call it IP, or sometimes people just call it the inflation rate. Okay, so now using this formula, we can figure out what expected inflation will be in the future, because expected inflation will drive expected future interest rates. So how do we do that? Well, you can go, and I have a slide here, for example, Treasury yields. This was as of December 1st, 2015. This came from the Wall Street Journal website. And if you look here, we can, for example, let's look here. Look at, you can't see it, but I wrote it out. November 30th, 2020. Okay, it's 5 years from now, approximately 5 years from now. The interest rate on a 5-year Treasury is about 1.6%. Okay, that's this number, 1.596. Okay, that is Treasury yield, and that's what you'd find on. This is basically the data underlying the yield curve. So you have maturity here, if you can't see it, and then you have the yield here. Okay, so we got that number. Now, we don't know what the two components are now, because nominal rates are decomposed into a real rate of return that allows you to gain purchasing power, and then you have to have an inflation premium built into it in order to keep this real purchasing power. So, for example, if inflation was expected to be 7% over the next 5 years on average, then you'd be earning a negative rate of return. That would be pretty poor. So this relationship is all tied together. The higher the inflation rate expectations, the higher the nominal rate. So this inflation rate should be kind of low, given that we only have a nominal rate of 1.6%. So how much is it? So, well, just gauging at this without knowing anything else, the inflation rate can't be higher than 1.6%. And so you have a good gauge right there. So the Federal Reserve will often say, look, and even in their press releases say, markets' expectations for inflation are low, or something to that effect. Well, it can just look at nominal rates and say, look, 5-year interest rates are only 1.6% per year. How high can inflation be? Because people are just not requiring a high inflation premium in there because they don't expect inflation to be high in the future. So we can actually figure out what this inflation rate will be by figuring out what the real rate is, believe it or not. And I have a slide here called Treasury Inflation Protected Securities. So as of December 1st, from the Wall Street Journal, we have Treasury Inflation Protected Securities known as TIPS. Now, these are issued by the government, and what the really cool thing about it is, here's maturity, these things have a yield that equals the real rate of return. In other words, these are bonds that are issued by the Treasury that will pay a real rate of return, which is specified, plus an inflation premium that's calculated based on actual inflation in the past, for the past year, the past quarter. And so the yield that you have, is the important point for you to know, is that the yield that's here is the real rate of return, and that is 0.210. So what that's saying is, think about that for 1 second. People are buying 5-year Treasury securities, and they only demand 1.6% in nominal rate of return. The gain in purchasing power is like 0.1%, which is unbelievably low. Now, the inflation premium has to be this minus the 2.1, and that comes to 1.386. So that is the market's. That is based on market rates. The market's expectations say that inflation is expected to be about 1.4% per year over the next 5 years. That's what it's saying. Okay, because this is the interest rate you're going to get over the next 5 years per year. You're going to get about 0.21% per year. And so inflation, your inflation premium, in order for you to keep this little thing here of 0.21, you need to have an inflation premium of 1.38, about 1.4%. So therefore, what I'm telling you is that in our today's markets, I can show you the nominal rate, I can show you estimates from the market of real rates, and we can back out what inflation premiums are. And we can also look at futures markets for interest rates also. So we have lots of gauges to see where the market is going in terms of interest rates, or at least what the market is thinking at the very moment. But keep in mind that anything can happen between now and the next 5 years, the end of 5 years. So this is just a guess at this point. It could be we have a major economic downturn, or major economic boom that nobody foresees, and interest rates could go up next year dramatically. Okay? But this is the expectations right now of what's going to happen. And so the expectations right now are saying, look, nobody sees an economic boom here. Nobody sees high inflation coming up. It's within the target, very close to the target of the Fed. The Fed has a target of inflation rate around 2%. So this is not far from it. The question is this going to start creeping up on us? Now, we finally get to the topic of monetary policy. And so now what we realize is that, look, when the money supply goes up, we know that R goes down, I, and that causes I in autonomous consumption to go up. And that causes aggregate demand to go up. So we have a shifter in aggregate demand now, real GDP, that causes aggregate demand to shift up if the Fed increases the money supply to reduce interest rates. So in other words, an expansionary monetary policy, as it would be called, expansionary monetary policy loosens the money reins. In other words, increases the money supply. The Fed buys Treasury securities, and when it buys it, it takes possession of the Treasury security and puts the Treasury security out in the and hands money over to the banks in terms of reserves. Okay, and so that's what monetary policy is designed to do. Now, it could use the open market operations, like I said before, or it could be they change reserve requirements, which changes the money supply, or they could use the discount window. But typically, it's open market operations that's driving this change in the money supply. Now, if the money supply drops, interest rates go up, I and A go down, and then aggregate demand curve goes down to the left, and so we shift to the left. And there you have it. Okay, so the lead up to all this, it took forever to lead up to all this, but so once we get there, the analysis is not too hard as to what's going on here. So here we have the long run aggregate supply curve. Here we have aggregate demand, and here we have a short run aggregate supply curve. And look at this. We have a gap, a recessionary gap here. Recessionary gap. And that means unemployment. That means, if we did nothing, eventually the market would respond by that gap. Based on changes in prices and wages and everything, would end up reacting to that. But let's say the Fed wants to speed this up. The Fed wants to get rid of the recession. It wants to keep a zero cyclical unemployment, and so this is cyclical unemployment, and so it's going to increase the money supply to decrease interest rates, and boom, we're back up to a higher level of aggregate demand. Now, a higher level of aggregate demand, and we're now back at our long run aggregate supply curve, which is full employment equilibrium. Okay, so there we have it. Now, notice what happens. We started out here. We started out here, and so somehow we went into a recession, and then we increased aggregate demand, so prices went up again. So you can imagine that. Let me see if I can put this in red. We probably had, I haven't shown you why this happened, but aggregate supply, let's call it -1. So we previously had an aggregate supply curve here, right? And what happened was, let's say we had an oil shock. We had an oil shock and input prices went up dramatically. It shifted the aggregate supply curve this way. And that's how we ended up here at the beginning of the story. And then what the Fed does is says, look, we got a recession. Let's increase monetary policy, expansionary monetary policy, and boom, we're back up here. The only problem with that is, notice what happens. You get a hit to inflation here, and you get another hit to inflation here. So you're likely, when you start hitting inflation several times, like through this mechanism, you could start an inflationary spiral. And that's exactly what happened in the 1970s, when we had oil shocks. So we had oil shocks. Let's see. Let me show you here. Okay, so here we start, equilibrium, everything's fine. Suddenly we get whacked with an oil shock. OPEC hits us. Short run aggregate supply curve moves in. We get a higher level of a higher price level, and a higher price level means inflation. You don't get from high CPI of 100 to 110, say, without having a 10% inflation rate. That's the definition of inflation. Okay, so not only do we have higher inflation, but we have a recessionary gap right here. And boy, that's two bad things going on. That's why negative supply shocks are the worst. Now, the Fed is in a tough. Everybody's in a tough situation here. The Fed has a mandate of keeping inflation stable, prices stable, and low unemployment. Well, it's got unemployment, and it just had inflation. So now, what can it do? It doesn't have the ability. The Fed doesn't really have much control of the aggregate supply curve. Fiscal policy does in some sense. That's where Reagan came in, and he said, look, if you tear down regulations, you cut taxes for workers, and you get more workers out there, and you cut taxes for companies, and businesses will be happy you can move the aggregate supply curve out there. But nobody wants to believe that anymore. So the Fed is sitting here now with in a bad situation. Since it can't really change the aggregate supply curve, and the U.S. government, the federal government doesn't want to move that this supply curve, then it can have an expansionary monetary policy, boom, to increase, get rid of the unemployment gap, increase GDP, and you're right here at this point. So we start here, we end here. But notice again, inflation and inflation twice. So what happens if you have another round of oil shocks, which is exactly what we had in the 1970s? Another round, and so we end up back here, and then we end up here, and then the Fed goes and increases, has an expansionary monetary policy to get rid of unemployment, and we're right back to long-run equilibrium. But notice, look at this. We keep running up the long-run aggregate supply curve, and all we have is inflation. Nothing really happened. Long run, we're still where we are. It's just that we have inflation. Well, that's how inflation can spiral out of control, and that's one explanation as to how the Fed, how the economy got to have such a high level of inflation. Now, with this in mind, let me embellish the story a bit and give you an even better story as to why there was inflation in the 70s and 80s. And it's certainly this. It's this story, but there's just a little bit more to it than that. First off, recognize that the Fed has several different things it can target. Running out of ink here. The Fed has several different things it could target. It could try to target inflation because it has a mandate to keep inflation or prices stable. Okay, so it can target a certain interest rate or a certain inflation rates, and it, now it says 2% now, so that's realistic. It can also target interest rates. And so the Fed targets interest rates and says, look, we want to have a targeted, for example, right now we have a targeted Fed funds rate between 0 and 1/4%. I mean, both of these things are spelled out in the press releases that come out. We've seen that in the past. There's also a third way of targeting things, and that's money supply growth. Okay, so they target, we want to have 2% money supply growth, or maybe sometimes it's often talked 3 to 4%, and that would be consistent with the increase in real GDP over the long run. So what you want to do is you just, instead of trying to keep track of inflation, keep track of Fed funds, let those prices and price changes go as they wish, but just keep the money supply stable. Just let it continue to grow, and if you let it grow, then and everybody knows that the money supply is going to grow at a nice stable rate, then maybe what will happen is these cyclical patterns will start to shrink a bit, and so you'll get less. These waves will smooth out a bit because everybody will know the money supply is just going to grow at this nice natural pace of 3 to 4%, which is where we have increases in labor productivity and population in there. And that would be the best way to stabilize the economy in the long run, rather than trying to fool around with targeting inflation and targeting Fed funds. Well, what happened in the 1970s was, it goes back to the story I was showing you a few minutes ago with the spiraling inflation. We just run up the aggregate supply curve. But one of the reasons why we ran up the aggregate supply curve was the Fed was targeting interest rates. Yeah, so in the 1970s, it didn't have a Fed funds rate that low. It used to target interest rates. And what happens is this, when it targets interest rates with an oil shock. So here we have aggregate demand, GDP, prices, long run aggregate supply, short run aggregate supply, and then we have a oil shock. Supply curve moves out to the left. We're right here, and prices go up. And what happens when prices go up? We know there's inflation. From here to this level is inflation. And what happens? Interest rates go up when price level goes up. So when the price level goes up, I mean, that's what I was showing you back here in this equation. When inflation goes up, interest rates go up. So inflation premium goes up, R goes up, and now if the Fed is targeting the interest rates, and this is its focus, what it's going to do is it's going to expand the money supply to bring interest rates down. Right? So here we have R, we have money supply, money demand, and we have money on this axis. Oops. So the Fed increases the money supply to bring interest rates down. When it increases the money supply, you got more money floating around in the economy. And remember this equation. You got GDP, you got money supply, that's an S there, at times velocity of money. If the quantity of money is fixed, velocity is relatively fixed, you shoot up the money supply, prices go up. So what happens is the Fed does an expansionary monetary policy, brings interest rates down, aggregate demand curve comes up. And so we have inflation. Now inflation caused by OPEC or oil prices going up. Now we have inflation due to monetary policy. And what that is likely to lead is, look, we just had an increase in GDP. And when GDP increases, money demand is likely to go up again. Okay, so money demand goes up. And so when money demand goes up, interest rates go up. The aggregate demand curve may want to shift down. But the point is, what's going to happen is you're going to have spiraling inflation, because when prices go up, interest rates go up, the Fed increases the money supply, and then inflation goes up again, and then so it increases the money supply again to bring interest rates back down, and you have a spiraling inflation scenario. all of this activity in the 70s caused Paul Volcker in 1979 to switch away from interest rate targets. He got away from interest rate targets and instituted a money supply target instead. So in October 1979, he gets rid of this interest rate targeting, decides that we ought to go on a money supply target, so that basically what he's saying is, look, running out of ink here, use green. So we have P times Q, this money equation, money supply times velocity. If we think of quantity being fixed, velocity being relatively fixed, then if he can control changes in the money supply by watching that, then we can control, and he could control changes in prices. When he was targeting, and when the Fed was targeting interest rates, and it wasn't just him, it was people before him in the Fed that targeted interest rates, the money supply got out of control. And so if we focus instead on targeting money supply, we'll be in way better shape. So in 1979, October of 79, he institutes the money supply targets, grows the money supply at a reasonable rate. Wow, what happens? Inflation comes down. Prices become relatively stable. In 1982, he switches back to an interest rate policy of targeting interest rates, and more than just and so again, that's why we have today the Fed funds target interest rate between 0.25%. But you know, we're not only just targeting Fed funds and interest rates now. We're also monitoring a close eye on what the money supply does, and we're also inflation targeting in a sense. The Fed says, look, inflation, its inflation target is 2%. So we have a Fed funds target of 0.25%. We have inflation rate targeted 2%, and the Fed is watching closely changes in the money supply so things don't get out of control. So we're now in a situation where the Fed is looking at all of the main variables and targeting nearly everything to some degree, and that comes out in the press releases. You know, the press release will talk about the targeted Fed funds rate, targeted inflation rate. It may at times talk about in their money supply, and if it's not actually in the press release, you look in its other documents, and it's looking at what that money supply is doing very carefully. And so there we have it, with the history of monetary policy in the past couple of decades. Now, what we've realized is, and I guess reconfirmed what people knew a while back, but and that is the concept of money neutrality. So here we have GDP, here we have prices, here we have long-run aggregate supply curve, aggregate demand, short-run aggregate supply curve. And so what money neutrality says is, look, we may at times be off this long-run aggregate supply curve. It's all short-run, and if you try to change, you try to conduct monetary policy, change the money supply, look, we always end up on this long-run aggregate supply curve. In the long run, we just can't stay in the short run, obviously. I mean, that's by definition, if we call it short run, can't stay there forever. So that no matter what happens, prices adjust in the long run. It's wages, it's input prices, all prices, commodity prices, goods prices, service prices, and all of that adjusts. And so we're on the long run aggregate supply curve, whether we like it or not. We're at a full run equilibrium. And so that's full employment, basically. And then anything else that happens is cyclical unemployment, which is the business cycle going up and down, and that is temporary. And one more thing, and I'll be done this video and done the course. This is the end of the course. Why did the Fed have interest rate target in the first place? If things got out of control, why did it do that? Well, it had interest rate targeting in its mind and employed interest rate targeting for decades before. after World War One, after World War Two, and it worked quite fine. The economy went nice and smoothly. We had a little blips, but we had a good economy in the late 40s, 50s, and early 60s. Things went quite well. So the Fed thought that, interest rate targeting was the way to go. And so when we got oil shocks, which we've never had before in the 1970s, the Fed thought, well, okay, it's a shock. It'll be temporary, and then, things will come snap back on, and we'll be in a long-run equilibrium. We'll be in long-run aggregate supply curve eventually. But it didn't realize that it was contributing to inflation, that inflation would get out of control. And so I think and nobody fully has a handle on this. If you talk to some economists who are around at the time, in their discussions, they'll tell you, look, we're not even sure why the Fed kept this interest rate targeting all along, but things looked really good for quite a long time. The Fed thought that was the way to go with monetary policy, and it turned out not to be the way to go in certain circumstances.